What if one bad day could erase weeks, maybe months of your whole portfolio? For 99% of the traders, that's what if. It's a brutal, repeated nightmare. This is a cycle of winning, feeling like you finally cracked the code, just to give it all back in a few destructive moments. This is why most of the people, most of the trader quits. But what if a single, simple rule could shield you from those catastrophic losses? What if there was some mathematical law that could basically keep you in the game for long enough to actually succeed? A rule so powerful it acts like a firewall to entire your trading account. This isn't some complex algorithm or secret indicator. It's principle so simple, so yet so profoundly effective. It's formed from a bedrock and nearly successful professional's career. This is the 1% rule that might be the last risk management video you'll ever need to watch. Does it sound familiar? You find a strategy, backtest it, say, hey, it works, and takes a few trades, and there you're winning. Your confidence is soaring. You started to think, this is it. I'm finally gonna make it. So sizing up and size the next trades because you looks like you can miss the setup, and then it goes completely against you. Panic mode, you nudge your stop loss, telling yourself it all come back. It doesn't. The loss gets bigger. Now you dip in the red, and that trade just torched the entire week's portfolio. Frustration turns into anger, and you immediately jump into another trade and another trade without a real plan, and just to make the money back. Or call it, as I've said it many times before, it's a revenge trading. It's the fastest way to blow up your account and erase your portfolio. Trust me, I've been there. I remember one day early in my career, where it was over like 30% of my account is under 2 hours. I was following a bad strategy. Sorry, I wasn't following a bad strategy. I was following just no strategy at all. My emotionally completely took a will. I broke even every rule that I made, and just feeling that like staring at the balance, staring at the balance, and your gut knowing that it's your own fault. It's feeling like you wouldn't wish to anybody else. It's a painful rate of passage. So many traders, but it doesn't have to be you. A real reason trader fails isn't because their strategy are awful or the case they can read the chart. Study after study shows it's almost always failure from the risk management, driven by your own psychological, good old-fashioned fear and greed. The market is a battlefield of probabilities, and without underpinning defense, your account it is fragile. You can have the best offense in the world, but if you have no defense, you're eventually going to end your career at the battlefield. And this is where the games changes. This is where you stop gambling. This is where you stop operating like a pro. So what is the blueprint defense? It's called the 1% rule. The rule is, call it just this: you are never under any circumstances allowed to risk more than 1% of your whole trading capital in one single trade. Let's sink it in. Not 10%, no 5%, just 1%. If you have $1,000 account, absolutely most you can lose in a trade is $100. If you have $1,000 account, your maximum loss is open $10,000. It's that simple. It isn't about limiting your profit. It's about guaranteeing your survival, about mathematical making it possible for any single trade to crush you. You remove probabilities of a catastrophic loss. A single a straight of 10 of losses in a row, which will happen to every single trade that doesn't wipe you out completely. With the 1% rule, it's just a manageable 10% down drawdown, not 50%, not 80%. Account is impulse. Here's the most critical, call it distinction between amateur and professional. Amateur focus on how much they can make. Professional obsessed with how much they can lose. The 1% rule does something magic for your brain. It defends the emotional bomb of trading when you know that the absolutely worst case scenario. It's a tiny, manageable 1% rule, a loss, and the fear of ruin vanish. You can execute your strategy with a clean head, knowing that no single trade defends your career. If it focuses you on stop focusing on the outcome of the one trade and instead focusing on the process of 100 trades. A long-term perspective in only thing is creating lasting success. Okay, so saying that you risk 1% is easy. Actually doing the requirement process, mechanical process, it isn't a guesswork. It's a simple math. Here's the 3 steps formula you must follow for every single trade, no exception. Okay, let's start with the first. This is the easy part. Just take your total account balance, multiply it by 0.01. Let's for the example, let's say you have a 25K account. So you run it and basically multiply by 0.01. There you go to $150. That's it. That's $250 maximum allowable loss on one single trade. This number is your line in the sand. It's not negotiable. If your account is 30K, you risk only $300 in a one single trade. If this drops to 20K during the drawdown, your maximum automatically risk shrinks to $200. The rule protects you. You could not let yourself press yourself to edge when you are hot. The second step is the second rule. Before you even think about hitting the buy button or sell button, you have to know where you get all of this. If you get all of this wrong, this is your step. your step of stop loss. Your stop loss isn't just a randomatic price. It's the exact technical level of the chart where your trade ideas proven invalid. Maybe it's just below the key support level, or just above the resistance, or maybe above or below the supply and demand area. The strategy defends you from yourself. This distance between your entry price and your stop loss is your per share risk. Let's continue to the example. If you wanted to buy, call it the Nasdaq or the mini Nasdaq contract, which is trading in the $50. The analysis showed that if the contract dropped to 48, your original idea is busted. The entry price was 50, stop loss was 48. Your risk trade defense is 50 minus 48. Call it $2 per the contract. Calculate your position size, and which is the step number 3. This is the final, most important step where it all comes together. This is where the 1% rule is actually enforced. Most of the traders do the completely backwards. They pick up a random number of share, or call it a share, or a number of contract they want to pull in the market, and they pray to about the stop loss. We're going to do it, and with precision. So the formula is a position size. We'll call it the maximum dollars you have, and divided by the risk per. Let's call it per share this time, using the number maximum dollar amount. Call it for risk is going to be $250. Risk per share, if you made it's $2. Position size would be 250 divided by $2 would be 125 a share. This is your answer for this trade. If you follow the 1% rule, you can buy exactly 125 shares of whatever stock that you choose to, not 200, not 500, exactly 125. If your stop loss get hit by $48, you lose only $2 per share. And on 125 shares for the total loss of $250, which is exactly when the 1% of your account. You're perfectly controlled your risk before you even entered the trade. The process needs to become a second nature. Mastering this three-step formula is life-changing. This is not just because it's protect your money. It actually makes you a better trader. First, you enforce and find high-quality trade. If a stock or contract is super volatile and needs to have a wide stop loss, your formula automatically gives you the smaller position. It reduces your exposure for a risk setup, not a flip side for a low risk setup, which is tight stop. It lets you take a larger position. The rule brilliantly adapt the trade to your risk limit. More important, it's forced you to think in a term of risk reward. You only risking 1% of your portfolio. You're not going to be very interested in a trade that can make you $100. That rule implicitly push you to find trades where the potential reward is at least 2 or 3 times of your risk. Risking 1%, making 3%. This is how your money is. This is how you make money in business. And even if you're call it only half. Even if you are only right at half of the time, this rules is universal. Though it doesn't matter if you're a day trader, swing trader, a long-term investor. It works for stocks, forex, crypto, futures, you name it. The math holds the true across the styles because it's based on a principle of capital preservation. And the capital preservation is a universal law for profitable traders and profitable trading. Ultimately, the 1% rules give you freedom to pull the trigger without fear, and the freedom to take losses without ruin your day. It's freedom. It's the freedom of knowing you are surviving any market condition, and can be able and will go back to trade tomorrow. This rule isn't a suggestion. It's a declaration of that you're taking your trading career seriously. It's a commitment of a discipline over emotion. It's moments you stop hoping and you start operating. If you're ready to make this commitment, if you're ready to make the disciplined ultimate edge, go down and comment right now on any type. I'm a 1% trader. Firm it, make it your own unbreakable rule starting today. Success in trading does not come from a holy grail. Strategy doesn't. It's never loses. It comes from having a system that lets you withstand the invisible losses and inevitable losses and stay in the game for long enough for your edge to play it out. The 1% rule is that system. It's that boring, unsexy mechanical work and rule that protects you from your single greatest enemy in the market, which is yourself. It's the foundation upon which towering careers are built. It's not just a rule that protects 99% of the traders. It's a rule that allows the 1% become constantly profitable. Master it, live by it, never break it. It will be the single best decision you ever made in your trading career.